Good afternoon, everyone. Thanks for the great sessions. Learned quite a bit. And thanks, Premji, for inviting me again. So what I'll try to do here is we typically get a lot of question around investing in global developed markets. So, for example, the strategy I run for Marcellus, it invests in the developed markets, which is North America and developed European markets. So what we try to do here, try to get some of the most commonly asked questions that, why you're investing in these particular markets, etc. What is the valuation, how the US market looks like in terms of, are you going into a recession, etc. So the things that we look from our lens, we'll just try to take a stab into those, how we are looking into investing into global developed markets. So the most commonly asked questions that why you want to invest in global developed markets. If you look at countries across the globe, there are a lot of countries which are growing much faster at much faster pace compared to an US or practically any country in the Europe. Then why do you want to invest in the US, right? Very valid question. In fact, when I started my career like 15 years back, I used to have similar kind of questions that why people should just go into all these emerging markets, right? That's where the growth is. But here are some startling things. Historically, we have seen many papers that has been written that there is actually no correlation between high economic growth of a country and that country's equity performance. Okay. Again, I'm not talking about just China. I've given an example of China here or Japan, but broadly, the papers that came before 2005, 2006, they also have seen that there is practically no correlation, almost zero correlation between high economic growth and equity market returns. Here I have just listed out China. If you look at China's growth in GDP, it has been like explosive to say the least. But if you look at their equity markets return, that is actually pretty average. In fact, it has returned much poorer than an Indian market or an US market over the last 25, 30 years. Even if I take out the last 5 years when the Chinese market struggled, to some extent, we probably know the story there. But before that also, China has never been a powerhouse when it comes to stock market return. So why does so happen, right? Why does so happen? So I'm pretty sure that you have heard about these arguments that US is practically 50 to 60% of the global equity market. So if you take any index, MSCI ACWI or MSCI Global Developed Market Index, United States market is around 60 to 70% of those indexes, right? Now that is not without any reason. So even though America's share of global GDP has come down quite drastically from close to 40% to now it is around 26, 27%. You can see that red line there. It has been consistently coming down. But the profit share of American companies, that has actually gone up significantly. It was around mid-30s, like 10, 15 years back. Now it is more than 50, 52%. In fact, their free cash flow, the free cash flow share of American equities, that is around 52% in the whole world, right? So whatever we talk about why US market has worked pretty well, definitely a bit of valuation, etc. helped. But at the same time, the profit generation has been unparalleled compared to any other countries in the world, and they have consistently gained market share. Now we can definitely debate why that has happened over the time. The most common reason or most viable reason probably is the fact that they have built an ecosystem of building intangible assets. So when I say intangible assets, think about a Google or a Facebook, etc., right? So you don't have a physical asset. So every incremental revenue that Facebook or a Meta, they used to generate before this AI spending, that you build it once, then the revenue and the profit actually comes through just utilizing the same asset again and again. So you're not investing more, right, in your fixed asset to generate more returns or more revenue. That was very unique what US did over last 10 years. And that kind of shows up in that line, in that blue line. Similarly, you can talk about deep financial markets. Again, that is nothing new. I'll just skip over this. Now, interestingly, yeah. Which one? Sorry. Yeah, so look, the basic point, like when you think about a SaaS company, software as a service, or even these social media companies that have built the platform once, then the network effect kicks in. Then the incremental revenue or incremental spending to get another person coming into the network is actually minuscule, right? You just need some resource on the back end, like server, etc., to support that growth. But unlike if you think about a factory, so if you are producing any additional unit for any particular goods, you need to actually, produce, keep some production line, etc., to make that happen. So if you compare those costs, the incremental return on the investment is massively higher for when your assets are actually intangibles, right? Now that actually shows up quite interestingly in India. Now India has been a spectacular story over last 15, 20, 30 years, right? I mean, the GDP growth has been pretty solid, definitely twice more than that of the US. But when you look back, what is the EPS growth? What is the earnings per share growth of S&P 500, which is the primary index in the United States, in dollar terms, versus what is the earnings per share growth of Nifty 50, again, the large cap market, the index that India has. Startingly, it is actually quite low. In fact, the S&P actually does better in terms of producing EPS growth. That has been the case. So the point that we are making, that capital allocation, building intangible assets, that actually helps the economy, the economy and the EPS growth engines completely separate. And as an investor in equity markets, what you really care about is the EPS compounding of certain markets. And that is where we feel that it definitely makes sense. If you want to go global, US is supposed to be a large part of your portfolio, and there is strong rational reason behind that. Now, again, there are a lot of reasons. I mean, there are a lot of books have been written about why it happens. So practically, there are two things that comes into my mind. The two top things is, kind of best education to some extent. Innovation engine works beautifully there. Of course, there are friction. There's no doubt about that. It is not perfect by any sense, but it's probably better than most of the other countries that you can find there. And one thing that is, I think, unique about US is the scale, right? US is the third most populous country in the world, and it is practically number one or number two if you think about the usable land that any country has in the world, right? So you typically do not see, growth as a challenge. Like, we talk about different kind of land reforms, etc., that, in India or many other emerging countries. But that is not a case for someone like in US. So that's a massive benefit when you think about the cost structure of any company. So with that, I'll go to the second most asked question that, okay, I get that. US market means I'm investing in the latest technology companies, and that is rational. We're in Bangalore, so you can find practically most of the large tech companies, based out of here. But if you just think about US, if you just go a little deeper, what will be surprising to find that most of the biggest return contributors in S&P 500 or Russell 1000 is not actually tech. In fact, you did a very simple exercise that, let's just go back 25 years. Which sectors have given the most multi-baggers over time, right? If I just take top 25 companies, then the ratio of tech in that multi-bagger cohort is 28%. If you go to top 50, that ratio goes down. What I'm trying to say is that US is actually a much, much broader market than just technology. And that is the beauty of it. We do not often talk about it, but I'll later on kind of, show like why it is important to understand that, that dynamic. So this is again a list I just prepared, like if you just look at last 25 years, which companies has produced the largest amount of return, which are listed in the US. This is a comprehensive list. You can just look at them. The number of representation from tech sector is actually not that high. In fact, the largest representation you will find in a sector called industrials, right? As a sector, you find that industrial is kind of dead, slow moving. But if you look at the equity returns, they're actually pretty hefty. So that is number two. So when you think about US, just don't think about investing in these big tech companies. That always comes into your mind. It is actually much broader than what you actually see or hear. Now, I'm pretty sure this is a pertinent question everyone has. Where do we stay? What is the, are you going to recession, etc.? I do not have a clear answer. It's very hard to call this economic, events. But whatever we're hearing, like when you think about the headlines around newspaper that U.S. Consumer Confidence Index is at their bottom, etc., we try to look at the raw data, which have been good predictor of recessions or any downturn in the US. The most important predictor has been the earnings per share growth of S&P 500. Right? In general stock market, if you think about stock market, it is a forward-looking animal. So typically the earnings per share growth tends to go down before it enters into a recession. You look at all the highlighted points here, the red line, the red circle there, the earnings growth dipped before US actually went into a recession. Where we stand on the top, on the right, we do not see that earnings growth slowing down. Okay, so that is number one. We can argue that, it is select few companies, select few sectors kind of pulling it up. But even if I look at the equal weighted S&P, even there, we do not see it going anywhere near close to where you have seen in the previous recessions. Number two, what is the health of the, what about the health of the consumer? What about the health of the big, large organizations? If they very heavily, levered, if there is too much of leverage in the system, that is what it shows, that the leverage of household debt to GDP, that is close to 20-year lows. If you look at the S&P 500 debt to GDP, it is again close to 20-year lows. If I look at the default rates broadly of the market, the default rates are actually coming down in the US market. So if you look at the right side, it peaked at around 2024, it is actually coming down. Now another part of it is, what about the US consumer? Are they making enough money to sustain, right? So this is an important parameter that I think is worth tracking. We call it real wage growth of the consumers. So if you look at back in 2006-07, before the GFC, the global financial crisis happened, it turned negative long before that, right? It's typically a good indicator of the US economic health, the consumer health. It has been positive for last almost 15 to 18 months now, right? So what we are saying here, I think it corrects here too, that if you look at broad US market valuation, it is absolutely, it is true to admit the fact that S&P 500, which is the top left, right? S&P 500 valuation at 22.5 times, it is much higher than what it has been historically, right? The dots that you can see here, that is the historical median valuation over last 10, 15, 20 years. But if you just look at little bit, under the hood, just look at the bar number 2 and bar number 3, right? So that is where we are looking at the broader US market. The equal weighted S&P 500, the S&P mid cap, the valuations are actually kind of in line with what they have been historically, right? Now, it is important to understand why this discrepancy, like say S&P 500 or NASDAQ, that has happened. Now, I'll just go to another slide here, just a second. This is the reason. So if you look at, these are the earnings EPS growth of different indexes in the US. So if you look at the adjusted earnings per share growth, S&P 500 does around 6-7%, 10% over a long period of time. Mid cap, equal weighted, they all do similar kind of growth over a long period of time. But what has happened in last 1 and 3 years, the growth has been so just driven by some of these large mega cap takes, right? That's why the rest of the market has not done practically anything. And that is where we do see a lot of opportunity that exists, both in terms of valuation. At the same time, we think that the earnings per share growth will eventually catch up to the longer term trajectory of 7 to 8% growth. And as a result, what we have tried to do here in GCP, before I go there, I'll just explain this on the valuation. The concern that, US is kind of in a situation what it has been in 2000, right? The dot-com boom and bust. So what happened back then, that for next 7-8 years, the broader indexes, if you invested in broad indexes, you actually never made money. So the rate part, right, 1.7% dividend yield. That's what you practically got. But the broader market, that is the mid cap and the S&P equal weighted, that actually generated very healthy return of 8 to 10%. So our point is that if you are concerned about your valuation in the US market, and rightfully so, you should have a portfolio which is more distributed around market caps, not only the just take mega caps. And that is practically what you have tried to do in GCP. GCP, I'll just keep it short here. It tries to identify very long global mega trends. So that mega trends that goes for 10, 15 years. And within that, we try to find out different cohorts where it can add a lot of value. The largest cohort that you say is pick and shovel. Basically, you find and identify a big mega trend, try to identify which is going beneath that surface, right? Similarly, the utilities, the things that you cannot live without in your daily life, not just the electricity or gas, but the likes of an Amazon or Microsoft. The third leg is the K-shaped world economic growth, right? If you think about the number of people who have become millionaires in India, that is growing at a very healthy pace. You guys know that better than me. So we have tried to identify companies that can actually benefit from that super rich, what they consume. And the outcome is something like this. And just go here. Sorry, let's come back. So we started the fund. What's that? Percent. Yeah. So we started the fund almost 3 years back. Okay, in October 2022. In fact, we just completed 3 years just a month back. And this is what it has been. In fact, this is the red line is S&P 500. The blue line is what you've done. But because of, the valuation, etc., the discipline around that, if you look at the drawdown of the fund has been much lower than what you see typically in the indexes, right? So that's how our point has been that if you go for a bottom of active strategy at this market, which might be, highly valued at broad index level, it probably makes sense to, invest in something like this, where you have some downside risk control. At the same time, over a long period of time, you can generate superior value. So with that, we actually did some analysis that I want to show here. Krishnan, you just, so we have our quant head actually here. So he made a very nice, he did a very good data crunching around why it makes sense to invest in active strategies at this point of time. I wanted to just explain in 2 minutes. We'll just start.
Sure. So again, what we wanted to show is different facets of concentration when you look at, these global equity benchmarks, right? So typically when people invest in broad global equity benchmarks, they assume that they're getting a diversified, kind of an exposure. But what we're trying to show here is that given where benchmarks are today, whether you look at US, whether you look at MSCI World. MSCI World, by the way, is developed markets. Basically tracks, 23, global developed markets in that index, all weighted basis the investable free float. And it's made up of around 1,300 stocks. But what you can see there is, the top 10 in that developed market, index, it's 28%, right? And the technology weight, the GICS, when I say GICS, the Global Industry Classification for Technology Sector, that weight is around 27%, right? Again, this 27% is record highs, right? So this, for MSCI World, for example, the weight of technology sector within the index reached, for example, 26%, right? At the time of dot-com bubble. So this would be in 1999. And even financials reached, not more than 25%, right? Just before the global financial crisis, right? So given the current concentration in the index, again, if you're looking for a broad diversified exposure through passive benchmarks, you're most likely, again, getting a very, concentrated exposure is not a good deal.
Yeah, so with that, I'll just conclude. I'm happy to take questions.
In the interest of time, we'll take the questions offline. But ladies and gentlemen, big round of applause for Arindam.